Let me tell you something most people misunderstand about wealth. You don't need $1 million to change your financial life. You need your first $100,000. I've seen this again and again. Once people cross that number, everything starts moving faster. Money grows faster, decisions get easier, financial stress drops. So today, I'm going to show you why the first $100,000 changes everything and exactly how to build it. When I talk to investors who successfully built long-term wealth, they almost always say the same thing. The first $100,000 was the hardest. Not because something magical happens at that number, but because reaching it changes how compounding works, how you behave with money, and how fast your wealth grows afterward. In this video, I'll show you why the first $100,000 feels painfully slow, what actually changes after you reach it, how experienced investors build their first 6 figures, and a simple framework you can follow. And later, I'll share a real case study that shows how this works in practice, because the lesson there changes how most people think about investing. Let's start with why this milestone is so difficult. Section 1. Why the first $100,000 is so hard. Early in your financial journey, almost all progress comes from your own effort. You're trading time for money, you're saving aggressively, and your investments barely seem to move. I remember when I first started investing, I would check my portfolio constantly, and after a year, the growth looked almost meaningless. It felt discouraging. Here's why. If you invest $10,000 and earn about 8% annually, roughly the long-term historical average of U.S. equities, though returns vary significantly, you make about $800 a year. Helpful, but not life-changing. Now compare that to $100,000 invested. At the same return, that's roughly $8,000 per year. Same market, same strategy, but completely different impact. This is the moment your capital begins contributing meaningfully to your progress. Early wealth building is driven mostly by income savings rate discipline. Later, wealth becomes increasingly supported by market growth. And that shift is what makes the first $100,000 so powerful. But there's something even more important happening behind the scenes: compounding. Section 2. What actually changes after $100,000? The compounding effect. Let's talk about the real engine of wealth: compound growth. Compounding means your returns generate additional returns. Your money starts earning money, and then that money earns more money. But here's the key. Compounding becomes visible only when the base amount is large enough. Assume a diversified portfolio earning around 8% annually over long periods. Again, not guaranteed. If $100,000 grows without additional contributions, after 10 years, about $216,000. After 20 years, about $466,000. After 30 years, around $1 million. That's from the original capital alone. Now imagine continuing to invest during that time. Growth accelerates dramatically. This is why experienced investors focus less on timing the market and more on building capital early and staying invested. Time becomes your biggest advantage. But there's another shift most people don't expect: the psychological shift. Section 3. The psychological shift that changes everything. Something interesting happens when your investments reach meaningful size. Your behavior changes. Before reaching significant savings, market drops feel scary, investing feels optional, spending feels easier than saving. After building substantial capital, growth becomes motivating, consistency improves, short-term volatility feels less threatening. Long-term thinking becomes natural. Behavioral finance research shows visible progress reinforces disciplined behavior, and investor behavior is one of the biggest predictors of long-term success. But let me show you what this looks like in real life. Section 4. Case study: how the first $100,000 changes momentum. A few years ago, I spoke with a software engineer. Let's call him Daniel. Daniel spent 5 years aggressively saving. He lived below his means, invested consistently in index funds, avoided speculation. Reaching his first $100,000 took him nearly 6 years. 6 years of slow progress. But here's what happened next. Over the following 4 years, without dramatically increasing his savings, his portfolio grew faster than ever. Why? Because his capital base was larger, market growth had greater impact, his habits were fully automated, he stayed invested through market volatility. His second $100,000 came much faster than the first, and this is common. The lesson here isn't that $100,000 guarantees success. The lesson is that early discipline creates momentum. Wealth building begins slowly, then accelerates. This is what many investors call the wealth snowball. Section 5. The wealth snowball effect. As your capital grows, investment returns can begin matching or exceeding your contributions. For example, early stage, you save $15,000 per year. Portfolio grows $2,000. Your effort drives progress. Later stage, portfolio reaches $250,000. 8% return generates about $20,000. Now your investments may contribute more than your savings. This changes everything. Over time, this dynamic can reduce dependence on salary, accelerate financial independence, make work more optional than necessary. But reaching this stage requires strong systems. So how do experienced investors actually build their first $100,000? Section 6. How investors build their first $100,000. Contrary to what social media suggests, most investors don't get there through risky bets. They rely on predictable systems. Strong savings rate. Early wealth is driven primarily by saving capacity. Many financially independent households save 20% or more of their income. Income growth and expense control matter more than investment selection early on. Diversified, low-cost investing. Many investors use broad market funds like S&P 500 index funds, total market ETFs, global equity funds. These provide broad exposure and long-term growth potential, though they still carry risk. Tax-advantaged accounts. Tax efficiency accelerates compounding. Examples include 401k and IRA accounts in the US, ISA accounts in the UK, superannuation in Australia, NISA accounts in Japan. Lower taxes mean more capital stays invested. Consistency over intensity. Automation removes emotion. Regular investing through market cycles builds long-term results. But there are also mistakes that delay this process. Section 7. Common mistakes that delay the first $100,000. I see these repeatedly. Lifestyle inflation. Income rises, spending rises faster. Trying to time the market. Excessive speculation or concentrated bets. Poor diversification. Inconsistent contributions. Avoiding these mistakes often matters more than chasing higher returns. So here's a simple blueprint you can follow. Section 8. The first $100,000 blueprint. If I had to start again today, this is the framework I'd follow. Increase your income capacity through skills and career growth. Maintain a high savings rate, ideally 20% or more. Build an emergency fund to avoid selling investments during downturns. Invest consistently in diversified assets. Automate contributions. Stay invested through market cycles. Simple doesn't mean easy, but disciplined execution produces results. Key takeaways. Your first $100,000 does not guarantee wealth, but it creates momentum. Compounding becomes visible. Financial discipline strengthens. Capital begins supporting growth. Long-term progress becomes easier. It's not just a number. It's the foundation of long-term financial security. Disclaimer: this content is for educational purposes only and not financial advice. If you found this helpful, subscribe for more evidence-based insights on investing and long-term wealth building. And remember, wealth isn't built through shortcuts. It's built through discipline, consistency, and time in the market. Your future wealth starts with your first milestone.